Have you ever wondered why some people who earn millions end up broke, while others who make modest incomes become wealthy? The answer isn't found in spreadsheets or investment formulas. It's hidden in the messy, irrational corners of human psychology. Today, we're diving deep into Morgan Housel's groundbreaking book, The Psychology of Money, to uncover 20 life-changing lessons that could transform how you think about wealth forever. Most people think money is about math, but here's the shocking truth. Personal finance is only 20% knowledge and 80% behavior. That's right, your emotions, biases, and psychological quirks have 4 times more impact on your financial future than any formula you'll ever learn. And by the end of this video, you'll understand exactly why your brain might be sabotaging your wealth and how to fix it. Let's start with lesson number 1, and this one hits hard. No one is crazy when it comes to money decisions. That friend who bought cryptocurrency at the peak, that family member who refuses to invest in the stock market, they're not crazy. They're responding to their unique experiences, circumstances, and psychological makeup in ways that make perfect sense to them. Think about it this way. If you grew up during the Great Depression, you probably view risk very differently than someone who came of age during the dot-com boom. Your personal history creates a lens through which you see every financial decision. A person who lived through hyperinflation will hoard cash. Someone who watched their parents lose everything in real estate will avoid property investments. Neither is wrong. They're just operating from different psychological starting points. This leads us to lesson 2. Luck and risk are siblings, and they're more influential than we want to admit. Bill Gates attended one of the only high schools in America that had a computer terminal in 1968. That's not skill, that's extraordinary luck. But here's what's haunting. His classmate Kent Evans was equally brilliant and passionate about computers, yet he died in a mountaineering accident before graduation. Same starting point, vastly different outcomes. The uncomfortable truth is that success often has more to do with being in the right place at the right time than we care to acknowledge. This doesn't diminish hard work or intelligence, but it should make us humble about our victories and compassionate about others' struggles. When you understand this, you stop assuming that wealthy people are inherently superior and poor people are inherently flawed. Lesson 3 will change how you view every financial goal you've ever set. Never enough is one of the most dangerous phrases in finance. There's always someone richer, always another level to reach, always more to want. The hedge fund manager who has $50 million looks at the billionaire and feels poor. The billionaire looks at the multi-billionaire and wants more. Here's what's tragic about this mindset. It guarantees you'll never feel wealthy, no matter how much you accumulate. Worse, it leads to catastrophic decisions. People with more money than they could spend in 10 lifetimes take enormous risks to get even more, often losing everything in the process. The antidote is defining enough before you start the wealth-building journey, not after you think you've arrived. This brings us to lesson 4, and it's about the 8th wonder of the world. Compounding doesn't just work with money, it works with everything. Warren Buffett's net worth is 96% attributable to wealth accumulated after his 65th birthday. Think about that. One of history's greatest investors made virtually all his money after most people retire. But here's the part that will blow your mind. Buffett started investing at age 11. If he had started at age 30, his net worth would be 90% smaller, despite using the exact same strategies. That extra 19 years of compounding made the difference between being wealthy and being legendary. Time is the most powerful force in finance, yet it's the one thing most people refuse to give their investments. Lesson 5 reveals why getting wealthy and staying wealthy require completely different skill sets. Getting wealthy requires taking risks, being optimistic, and putting yourself out there. Staying wealthy requires humility, fear, and a survival mindset that prioritizes avoiding catastrophic losses over maximizing gains. Many people who are great at getting rich are terrible at staying rich because they can't make this psychological transition. They keep taking the same big swings that made them wealthy in the first place, not realizing that preservation requires a fundamentally different approach. The skills that make you money aren't necessarily the skills that keep you money. Now we arrive at lesson 6, and this one will make you question everything you think you know about financial planning. Tails drive everything. In investing, A small number of events account for the majority of outcomes. Most stocks fail, most investments disappoint, most businesses collapse. But the few that succeed do so spectacularly, more than making up for all the failures. This means that being wrong most of the time is not only acceptable, it's expected. Amazon stock fell 94% during the dot-com crash. If you sold, you missed out on one of the greatest investments in history. The lesson isn't to hold everything forever, but to understand that extraordinary results often come from ordinary investments that survive long enough to compound. Lesson 7 hits at the heart of why most financial plans fail. Freedom is the ultimate goal of money, not stuff. The highest dividend money pays is the ability to wake up and say, I can do whatever I want today. Yet most people trade this freedom for material possessions that create new obligations and dependencies. That luxury car comes with payments, insurance, and maintenance costs that reduce your options. The expensive house in the prestigious neighborhood locks you into a high-cost lifestyle. Every purchase should be evaluated not just on what it costs, but on how it affects your freedom to make future choices. Money's greatest intrinsic value is its ability to give you control over your time. This leads to Lesson 8, which explains why flashy displays of wealth often signal financial weakness, not strength. Wealth is what you don't see. It's the income not spent, the cars not purchased, the clothes not bought, the first-class upgrade declined. It's financial assets that haven't yet been converted into the material possessions you see. Someone driving a $50,000 car might be wealthy, but the only thing you know for certain is that they have $50,000 less than they did before they bought the car. The person driving the 10-year-old Toyota might have millions in investments. Wealth is hidden, income is visible, and we often confuse the two. Lesson 9 will transform how you think about life's biggest financial decisions. Be reasonable, not rational. The academically optimal financial decision might be perfectly rational on paper, but completely unreasonable for your psychological well-being. If losing sleep over your aggressive investment portfolio makes you miserable, it doesn't matter if it's statistically optimal. A reasonable portfolio that you can stick with through market crashes will always outperform the perfect portfolio that you abandoned during the first downturn. The goal isn't to be coldly rational, it's to make decisions you can live with for the long term. Your financial plan should fit your personality, not the other way around. Lesson 10 exposes one of the biggest mistakes people make when learning about money. Surprise is the most powerful force in the world, and it's impossible to predict. Every recession, every boom, every market crash happened because something unexpected occurred. Yet we study history looking for patterns we can use to predict the future. The problem is that the biggest events that will shape tomorrow are by definition unpredictable. If experts could consistently forecast major economic events, they would prevent them from happening through their actions. Instead of trying to predict surprises, build a financial plan that can survive them. Expect the unexpected by maintaining flexibility and avoiding catastrophic risks. Moving to Lesson 11, and this one will change how you view every expert opinion you encounter. The world is driven by extremes, but we focus on the middle. Media attention, book sales, and investment flows all go to the most dramatic stories and the most extreme outcomes. This creates a distorted view of normal. The boring, steady, consistent approach doesn't make headlines, but it builds wealth. The extreme stories get all the attention, but the mundane strategies generate most of the results. Don't let the spectacular failures and successes distract you from the power of staying the course with simple, sustainable approaches. Lesson 12 reveals why timing the market is not just difficult, it's counterproductive. Room for error is the most important part of any financial plan. Things will go wrong, markets will crash, jobs will be lost, emergencies will arise. Your plan needs to account for these inevitabilities, not pretend they won't happen. This means maintaining larger emergency funds than mathematically optimal, avoiding maximum leverage even when it could boost returns, and keeping some flexibility in your investment approach. The goal isn't to maximize returns under perfect conditions, it's to ensure survival under imperfect ones. Lesson 13 challenges everything Wall Street wants you to believe about investing. You'll change your mind, and that's okay. Your goals will evolve, your circumstances will shift, Your priorities will adjust. The investment strategy that made sense when you were 25 might be completely wrong when you're 45. Rather than feeling guilty about changing course, embrace it as a natural part of the wealth-building journey. The key is making changes thoughtfully, not reactively. Update your approach based on genuine life changes, not market movements or the latest investment fad. Now we reach lesson 14, and this one explains why lottery tickets and insurance are both rational purchases despite seeming contradictory. Nothing is as good or as bad as it seems. When markets are soaring, everything feels perfect and permanent. When they're crashing, everything feels hopeless and broken. Both extremes are illusions. The euphoria of bull markets creates dangerous overconfidence. The despair of bear markets creates paralyzing fear. Successful investors learn to maintain emotional equilibrium during both extremes, remembering that markets are cyclical and current conditions are always temporary. Lesson 15 will revolutionize how you think about your career and income. History never repeats, but it rhymes. The specific events of the past won't happen again, but human nature remains constant. Greed, fear, overconfidence, and panic drive markets today just as they did a century ago. Study history not to predict the future, but to understand the range of human behavior during different market conditions. This knowledge won't tell you when the next crash will happen, but it will help you recognize when market psychology is reaching dangerous extremes. Lesson 16 addresses one of the most emotionally challenging aspects of building wealth. Seductive ideas often have the most distant beneficiaries. The best financial decisions benefit your future self, not your current self. Saving money means less consumption today for more options tomorrow. Investing in diversified index funds means accepting boring returns instead of chasing exciting stories. The most seductive financial decisions promise immediate gratification or dramatic results. Day trading feels more exciting than index investing. Buying individual stocks feels smarter than owning the entire market. But excitement and intelligence in finance often lead to poor outcomes. Lesson 17 reveals why your relationship with money is more important than the amount you have. Optimism is a rational stance if you believe progress is possible. Despite constant negative headlines, the long-term trajectory of markets, technology, and human prosperity has been consistently upward for centuries. This doesn't mean everything always goes up or that setbacks don't happen. It means that betting on human ingenuity and progress has historically been a winning strategy. Pessimism feels smart and sophisticated, but optimism has been more profitable and more accurate over long time periods. Lesson 18 will change how you evaluate every financial opportunity. Stories are more powerful than statistics. A compelling narrative about why a particular investment will succeed is more persuasive than a spreadsheet full of numbers. This is both the greatest strength and the greatest weakness of human financial decision-making. Stories help us understand complex topics and motivate us to take action, but they can also lead us astray when we prioritize narrative coherence over factual accuracy. Learn to appreciate the power of stories while maintaining healthy skepticism about investments that rely too heavily on compelling narratives rather than solid fundamentals. Lesson 19 addresses one of the most controversial topics in personal finance. Debt can be a tool, but it's a dangerous one. Leverage amplifies both gains and losses, but more importantly, it amplifies emotions. When investments purchased with borrowed money decline, the psychological pressure can lead to panic selling at the worst possible times. The mathematics of leverage might make sense, but the psychology often doesn't. Many fortunes have been lost not because the underlying investments were bad, but because debt created emotional pressure that forced sales during downturns. Use debt sparingly, and only when you can handle the psychological burden as well as the financial risk. Our final lesson, number 20, ties everything together and reveals the ultimate truth about money and happiness. Money's greatest gift is providing options, not outcomes. Financial security doesn't guarantee happiness, but it provides the freedom to pursue whatever might make you happy without worrying about paying rent. This is why the relationship between money and happiness is complex. Once basic needs are met, additional money provides diminishing returns in terms of direct happiness, but increasing returns in terms of flexibility and options. The goal isn't to accumulate money for its own sake, but to build enough financial security that money stops being a constraint on your choices. So what do all these lessons mean for your financial life? First, recognize that your money decisions are driven more by psychology than mathematics. Embrace this reality instead of fighting it. Build a financial plan that accounts for human emotions, not just spreadsheet calculations. Second, focus on survival over optimization. The best investment strategy is the one you can stick with through multiple market cycles, not the one that looks best on paper. Prioritize avoiding catastrophic losses over maximizing gains. Third, remember that time is your greatest asset. Start investing early, be patient with compound returns, and resist the urge to constantly tinker with your approach. Boring consistency beats exciting volatility in the long run. Fourth, define enough before you start building wealth. Know what financial independence looks like for your specific situation and stop chasing more once you've reached it. The hedonic treadmill ensures that moving goalposts will never lead to satisfaction. Finally, use money as a tool for freedom, not status. Every financial decision should be evaluated based on how it affects your ability to control your time and make autonomous choices. Wealth that reduces your options isn't wealth at all. The psychology of money reveals that financial success isn't about being smart. It's about being reasonable. It's not about predicting the future. It's about preparing for uncertainty. It's not about maximizing returns. It's about maximizing the probability of achieving your goals. These 20 lessons from Morgan Housel's brilliant book provide a roadmap for navigating the complex relationship between human psychology and financial success. They remind us that money is ultimately about much more than money. It's about freedom, security, options, and the ability to live life on your own terms. Understanding the psychology behind your financial decisions is the first step toward making better ones. Armed with these insights, you're now equipped to build wealth not just with your head, but with a clear understanding of your heart. Because in the end, the most successful investors aren't those who ignore their emotions, but those who understand them well enough to make rational decisions despite them. If these lessons resonated with you, make sure to subscribe for more insights on building wealth and understanding the forces that drive financial success. What money lessons surprised you the most? Share your thoughts in the comments below. And remember, your financial journey is unique to you, but these psychological principles are universal.